Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, May 4th, 2026, and we're kicking off the week with some serious geopolitical concerns making waves across markets. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story right now is the escalating tension in the Middle East, specifically around the Strait of Hormuz. We've got conflicting reports about potential Iranian strikes on US naval vessels, and while the US has denied that any warship was hit, the mere fact that these reports are circulating is sending shockwaves through energy markets and creating significant volatility in stock futures. Oil prices are climbing on these fears, and we're seeing that classic flight to safety behaviour starting to emerge. What makes this particularly concerning is the strategic importance of the Strait of Hormuz for global energy flows. Beyond the geopolitical situation, we're also seeing some notable corporate developments that are capturing attention. GameStop just announced a massive $56 billion offer for eBay in what they're positioning as a direct challenge to Amazon's dominance. This is a bold move from a company that's been trying to reinvent itself, and it shows how aggressive some players are getting in the e-commerce space. On the tech side, AI chipmaker Cerebras is targeting a $3.5 billion raise in their IPO, which tells us that despite market uncertainty, there's still substantial appetite for AI infrastructure plays. And Anthropic is close to finalizing a $1.5 billion joint venture with Wall Street firms, further cementing the financial sector's commitment to AI integration.
Those are significant developments across multiple sectors. How are you reading the market's interpretation of these events, particularly the geopolitical tensions?
The market reaction has been telling. We're seeing that whipsaw action in futures, and oil that suggests traders are struggling to price in the risk premium here. What's interesting is that while there's clear concern about the Middle East situation, we're not seeing a full-blown panic sell-off yet. Markets are in a wait-and-see mode, trying to determine whether this escalates further or gets contained diplomatically. The oil price movement is the most direct impact we're seeing, and if this situation persists or worsens, we could see energy stocks outperform while transportation and logistics companies face margin pressure. There's also an underlying theme that's been building for weeks now, and it's becoming more apparent in the data. We're starting to see markets price in stagflation concerns, that uncomfortable combination of slowing growth and persistent inflation. This is showing up in how different asset classes are moving relative to each other. And here's something that really stands out. Berkshire Hathaway is sitting on a record $397 billion in cash, and they're not alone in being reluctant to deploy capital aggressively in this environment. When you see that level of cash hoarding from sophisticated investors, it tells you something about confidence levels and risk assessment at the institutional level.
That cash position from Berkshire is remarkable. What does this mean for traders and investors trying to navigate these conditions?
It means we need to be selective and tactical rather than making broad directional bets. For the indices, let me break down what I'm seeing technically. The S&P 500 is holding near record levels, but we're seeing some divergence in the internals. If the geopolitical situation stabilizes, we could see the S&P test new highs, but if tensions escalate, the first support level to watch is around 5,850, with stronger support at 5,780. The index is showing resilience, but breadth is narrowing, which is a caution flag. The Nasdaq is more vulnerable here because of its heavy tech weighting and growth stock concentration. We're seeing some profit-taking in the mega-cap tech names, and if risk-off sentiment intensifies, the Nasdaq could underperform. Key support sits around 18,200, and a break below that could trigger more technical selling. On the upside, we need to see 18,800 reclaimed with conviction to suggest the pullback is over. The Dow is actually showing relative strength, which makes sense given its value tilt, and the fact that it includes more defensive names and traditional industrials. The Dow's composition gives it some insulation from the growth stock volatility we're seeing elsewhere. Support is around 40,500, and if we get a relief rally on easing geopolitical concerns, the Dow could lead the way higher toward 44,000.
That technical breakdown is helpful for understanding the positioning across different market segments. What's your take on the corporate developments, particularly GameStop's move on eBay?
The GameStop eBay situation is fascinating from a strategic standpoint, though I'd approach it with significant caution as a trading opportunity. GameStop has been trying to transform itself for years now, and this $56 billion offer represents a massive bet on becoming a legitimate e-commerce player. The question is whether they can actually execute on integrating eBay's platform and whether this creates real value or is just empire building. For traders, this kind of major M&A announcement typically creates volatility in both stocks, and we'll want to watch how the market assesses the deal's probability of completion and the strategic rationale. On the AI front, the Cerebras IPO and the Anthropic joint venture are more straightforward positive signals. The fact that Cerebras can target a $3.5 billion raise shows that institutional investors still have appetite for AI infrastructure, especially companies that are competing with or complementing Nvidia's dominance. The Anthropic deal with Wall Street firms is significant because it shows financial institutions are moving beyond just talking about AI to making substantial capital commitments. These are the kinds of developments that can support the AI theme, even when broader market sentiment is shaky. For sector rotation, if the Middle East situation escalates, energy becomes the obvious beneficiary. But we also want to look at defense contractors and companies with pricing power that can pass through inflation. If tensions ease, we could see a relief rally that favors the growth and tech names that have been under pressure.
That selectivity is going to be key in this environment. Steve, let's get into the economic numbers. What's the picture looking like on the data front this week?
Thanks, Robert. We're in a relatively light week for major economic releases. But what we do have on the calendar carries weight, given the current market concerns about stagflation. Today we're getting the ISM Services PMI for April, and this is particularly important because the services sector represents about 70% of the U.S. economies. Economists are expecting a reading around 50.5, which would indicate continued expansion, but at a modest pace. What we're really looking for in this report is the prices paid component, because that gives us insight into inflationary pressures in the services sector, which has been stickier than goods inflation. If we see prices paid coming in hot, while the headline number shows slowing activity, that reinforces the stagflation narrative that markets are starting to price in. We also get factory orders data today, which will give us a read on manufacturing demand. This has been weak in recent months, and another soft print would add to concerns about the industrial side of the economy losing momentum. On Wednesday, we'll see the ADP employment report, which is a private sector payrolls estimate that comes before the official jobs report. This has become less reliable as a predictor of the official number, but it still moves markets and gives us a sense of hiring trends in the private sector. Expectations are for around 140,000 jobs added in April. Thursday brings us initial jobless claims, which have been creeping higher over the past few months. We're watching to see if claims continue that gradual upward trend, which would suggest some softening in labor market conditions. The 4-week moving average is what matters more than any single week's number because it smooths out volatility. And then Friday is the big one. The April Employment Situation Report, which includes non-farm payrolls, the unemployment rate, and wage growth data. This is always a major market mover, and given the current debate about whether the economy is slowing too much or remaining resilient, this report will be scrutinized heavily. The consensus is looking for about 80,000 jobs added, with the unemployment rate holding steady at 3.9%. Average hourly earnings growth is expected to remain around 3.8% year over year. What makes this report particularly important right now is that we're trying to gauge whether the labor market is cooling in a healthy way that brings inflation down, or whether we're seeing the beginning of a more concerning slowdown that could tip us toward recession. The Fed is in a difficult position because they want to see the labor market soften enough to ease wage pressures, but not so much that it triggers a sharp rise in unemployment.
Those employment numbers on Friday will definitely set the tone for next week. Lizzie, let's shift to crypto. What are you seeing in digital assets heading into next week?
The crypto market is showing some real strength, particularly Bitcoin, which has climbed past $80,000 for the first time since January. The sentiment around Bitcoin is decidedly bullish right now, and we're seeing multiple factors converging to support higher prices. Bitcoin is preparing for its highest weekly close since January, hovering near $79,000, and analysts are suggesting it can easily hit $95,000 based on the current momentum and technical setup. What's driving this move is a combination of institutional adoption signals and political developments. Morgan Stanley is now advising clients to consider 2 to 4% Bitcoin exposure, which is a significant endorsement from a major wealth management firm. We're also seeing discussions about Bitcoin potentially appearing on US bank balance sheets, though that's still in the future rather than imminent. Trump's announcement of something called Project Freedom provided additional momentum, though the details are still emerging. On the institutional side, companies like Strategy have taken a pause in their Bitcoin buying ahead of their Q1 earnings report, which actually suggests a measured strategic approach rather than panic buying. Bitcoin mining stocks are climbing as well, with Riot expanding its AMD data center deals, signaling a pivot toward AI infrastructure alongside mining operations. For next week, the key resistance levels to watch are around $84,000 to $85,000 based on options data, though the options market is pricing only a 25% chance of reaching $84,000 in May, which tells us institutions remain somewhat cautious despite the rally. There's also an interesting warning from veteran trader Peter Brandt, who sees Bitcoin eventually hitting 250,000, but only after a bottom later this year. So we need to be prepared for potential volatility, even within a longer-term bullish outlook. Ethereum is showing a more mixed picture with neutral to slightly bearish sentiment. The Ethereum Foundation just completed a sale of 10,000 ETH to Bitmine in their third OTC deal as part of their treasury strategy. And while this is a planned activity, it does create some supply pressure. There are also legal challenges affecting the ecosystem, including a US law firm attempting to block frozen ETH transfers from the kelp exploit, and Arbitrum DAO is facing a 71 million ETH court freeze, which creates some uncertainty around governance and legal issues. On the positive side, Ethereum is approaching a bullish MACD crossover from a technical standpoint, and if it can break above the 2,400 resistance level, we could see renewed momentum for next week. I'm neutral on Ethereum, watching that 2,400 level closely because the foundation selling and legal issues are offsetting the technical improvements. Solana is looking bullish heading into next week. The key development here is Coinbase boosting Solana trading with DFlow integration, which should improve liquidity and make trading more efficient. Technically, Solana is showing strength with potential to break the $90 resistance level, and if it does, we could see a momentum-driven move higher. The infrastructure improvements and continued development on Solana are providing fundamental support for the price action. In terms of institutional versus retail positioning in Bitcoin specifically, we're seeing institutional money becoming more comfortable with allocation, evidenced by the Morgan Stanley guidance and the discussions about bank balance sheets. Retail interest is picking up as Bitcoin crosses these psychological levels like $80,000, but institutions are driving the current move with more measured strategic accumulation. ETF inflows are recovering, though not completely back to the peak levels we saw earlier, and that institutional flow is what provides the foundation for sustained moves higher rather than the volatile pump and dump action. We sometimes see with purely retail-driven rallies, the risk factors to monitor include the Q1 earnings reports from Bitcoin holding companies, which could create volatility depending on how their strategies are performing, and any regulatory developments, particularly the Senate progress on crypto clarity legislation. Overall, Bitcoin is leading with strong momentum, Ethereum is in a wait-and-see mode, and Solana is showing promise as a selective altcoin opportunity for next week.
That wraps up today's Morning Bell. We've covered a lot of ground from geopolitical tensions affecting energy markets to the institutional embrace of Bitcoin and the key economic data coming Friday. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow as we continue tracking these developing stories. I'm Robert, thanks for listening.